Welcome to my YouTube channel, and as we get ready to actually see how to prepare a profit and loss account as well as a balance sheet, I would kindly request you to subscribe to my channel by clicking on the button below, just in case you are new to this particular program. Now, we have some piece of information which are actually extract of accounts relating to a particular business. We have sales all the way to creditors. And of course, we are also given additional information which are actually making part of the adjustments that are supposed to be made. Then from this information, we are required to prepare a trading profit and loss account for the year, as well as the balance sheet, that is the statement of financial position as at the date given in this particular information. Now, if you talk about the trading profit and loss account for any typical business, it is this particular financial statement which normally starts from the point goods are purchased until those goods are sold. And thereafter, we will compare the sales with the cost of sales to determine whether that particular business made a loss or a profit. Now, we have sales, and sales we normally have a credit balance. So we are supposed to always have the sales on the right hand side, that is on the credit side, and any items which affect sales. For example, in this case, we have sales returns. Sales returns simply refers to those part of sales which have been returned back by the customers. In other words, the customers have found them not to be effective, so they return them back to the seller. They are supposed to be less from the sales to actually give the true value of sales, which are supposed to be used in comparing with the cost of sales to see whether there was a profit or a loss. Now, like I said, we normally have sales on the right hand side and factors to do with purchases and items which affects purchases on the debit side, on the left hand side. Then we are going to compare. So when you begin with sales, and we're given the sales amount to be 750,000. So we have an amount of 750,000. And as I said, we are supposed to less sales returns because these are part of sales which the customers have returned back to the business, maybe because they have wrong quality, and the sales returns amount is for 24,000. Then we are going to have what is known as the net sales. Now this is the new value of the sales after the returns, and the amount is supposed to be 726,000. This is now what we'll compare. We will compare this one with the cost of sales. So for us to get the cost of sales, normally we are supposed to have at the beginning of an amount to do with purchases. So when you have purchases, these are the amount of goods which were purchased, which is 540. So you have 540,000 as per the equation. And then of course also given returns outwards. These are amounts of goods which the business is returning back to the supplier. Again, could be due to the reasons as to why sales returns were returned by the customers. Maybe these goods were also damaged and so many other reasons. So we are supposed to less the returns outwards. The returns outwards which are moving out, which are not now part of the purchases, an amount of 30,000. 10,000 and we have a value of 10,000. So this business purchased this 540,000. Afterwards, they returned back this 30,000. It means what is now remaining is 510. This one is now the cost of goods available for sale, which are supposed to be sold to compare with the sales and see whether there was a profit or a loss. So this is actually the cost of goods available for sales. The business is supposed to sell this one. But now you see, if this is what is available for to be sold, then we are told that at the end of this particular accounting period, that is on 31st December 2010, the value of stock was 72,000. Remember, this 72,000 is part of 510,000. It means some amount of goods have already been sold. So we have this one which is supposed to be sold, and then we remain with this particular value. So we are supposed to determine the amount of goods that were sold. In other words, you're supposed to determine the cost of goods that were sold. So we less what is remaining in the business, which is referred to as the closing stock. The amount is 72,000. 72,000. When we less it from this one, we get a value of 438. 438,000. So this one is the cost of goods sold. That is the cost of goods, or the cost of what was sold. So the cost of goods sold is like an expense which was incurred when these sales were being made. So you're supposed to determine. You can see that the sales were higher than the expense which was incurred. It means there was a gross profit. So we are supposed to balance these particular entries by determining the difference. 726,000 minus 438,000 is supposed to have a value of 288,000. Now that value is supposed to be written on this side, which has the smaller total, 288,000, and we denote it as gross profit carried down. Now this is the gross profit which is supposed to be carried down. When you add these two, we are supposed to have a value to do 726,000. Then we carry it down, we write it below this particular total here as 288,000, and this is supposed to be gross profit which has been brought down. Now, because we have gross profit in this case and not gross loss, we will add all the revenues to gross profit and compare with the expenses to see whether there was a net loss or a net profit. Now, after that, we are supposed to add any items which refers to revenues to the gross profit. So this one is supposed to be added to revenue. We are supposed to add revenue, and from our working, we can see that our revenue is, the first one is commission received. So we are supposed to add, we add revenues. The first one is commission received, which is an amount of 24,000 as given. The other revenue is supposed to be, no, we don't have any other revenue. So we now debit the expenses again. You want to see the total of the expenses of this particular business by determining the first expense as general expense is given as 72,000. So you're supposed to have general expense as an amount of 72,000. And then you go to another expense. The next expense supposed to be electricity expense, which is 16,000. But we are told from the equation, from the additional information, that electricity prepaid was 4,000. The word prepaid means this particular amount of 4,000 was paid on electricity, but has already not been expensed. This particular amount will be taken to the balance sheet as an asset because it has not been utilized. At the same time, the amount is supposed to be less from the expense. Why? Because if you have an expense of 16,000 and then you realize that the same expense of electricity, you had already paid 4,000 in advance. This is an advance payment. It means we are supposed to less it from 16,000 to get a value of 12,000, which is the actual amount of expense which is supposed to be utilized, which is supposed to be debited in the profit and loss account. Then you have rent expenses accrued. Again, a rent expense accrued means outstanding expense. This expense has not been paid. In other words, it will be taken to the balance sheet as a liability because it is owing to the business, has not been paid. The same amount is supposed to be added. It is supposed to be added to the rent expense because it is an increase. It is an increase in expense, so it will be added to actually get the total expense as per that account. Then again, we are given depreciation. So we are given motor vehicle per annum on cost. Again, depreciation is again an expense in this particular working. Like for motor vehicle, we are given as 15% times the on cost. So it is 15 of cost, and the cost of motor vehicle is 720,000. So it means if you work out 15% of that one, we are supposed to get a value of, so 15% of 720,000, we get a value of 108,000. That is the amount of depreciation. So the difference is what will be transferred to the balance sheet. So 720 minus 108,000, which is actually, so 720 minus the answer, which is actually 620,000, 612,000 will be transferred to the balance because this is actually the book value of the motor vehicle. Then for furniture, we are supposed to have 6% per annum on cost for furniture. That is the amount of depreciation. So we get 6% times furniture cost is 288,000. So times 288,000. So 0.06 times 288,000, we get a value of 17,280 shillings for this particular working. So the difference between 288,000 and 17,280 is what will be transferred to the balance sheet because that is the book value of furniture after an amount of this one has been lost. So 288,000 minus 17,280, we get a value of 270, 720. So 270, 720. So these particular two values are supposed to be transferred to the balance sheet. These are the book values. So we are going to see how to actually. So we have made our adjustments. Now, general expenses was that one. Then we talk about electricity expense. Another expense is electricity expense, and the amount is given as 16,000. But now you see, we are told that the prepaid expense was 4,000, so we are supposed to less the prepaid because actually it reduces the expense. Prepaid means was paid in advance, so we less prepaid. So prepaid expense, which is 4,000, we less than, we get a value of 12,000. This is what we add to the general expense. Again, we have another adjustment on rent expense. So we have rent expense, which is an amount of rent expense was an amount of 2,500, and an accrued rent accrued was 3,500. So it means it increases the expense. So we're supposed to add the rent that was accrued. We get at a value of 3,500. So this one is 6,000. So when we add this one, is supposed to get a value of not really. I think we still have some other expenses to do with provisions from depreciation, provisions for depreciation, and the first one was the motor vehicle depreciation. So on motor vehicle, which was 15%, we got at the value of 108,000. Then we add another provision, which is actually on furniture. So the furniture provision was 17,280. When we add these two, we get a value of 125,000. So we get a value of 125,280. So 125,280 is the total of the provision depreciation. Then we are supposed to add the total expenses, which is actually 72,000 plus 12,000 plus 6,000 plus 105,250. We get a value of 215,280. So we get a value of 215,280. This one is the total expenses for this particular business. Now, we see that when you add our commission, when you add our revenue to the gross profit and compare with this one, you want to see which one is higher. So our 288,000 plus 24,000, we get a value of 312. So the total of sales plus revenues was more than the expenses, so it means we have a net profit. So it means that when we write this value at some particular level here, which is 312,000, we get the net profit by subtracting the total sales from the total revenue. So the value minus 215, 280, we get a value of 96,720. We write it here at 96,720, which is actually the net profit which is being carried down. We confirm the two sides are equal by adding that way, double underline. The net profit is being carried down, so it's supposed to be brought down on this particular side, on the credit side. I give it a name as net profit brought down. Now this one will be transferred to the balance sheet and it will be added to the capital as we work out the balancing of the balance sheet. Now this is how we do our trading profit and loss account. Our trading account part is completed at the point at which you get the gross profit. Now when we start working on the revenues all the way to expenses, we are now talking about what is known as the profit and loss account. Now I want us to go to the next step. For now, determining the balance sheet or the statement of financial position. And a typical balance sheet will normally follow the bookkeeping equation, whereby we have the capital and liabilities on the credit side and assets on the debit side. So the total of the credit with the liabilities are supposed to be equal to the total of the assets. If they are not equal, it means that some working is not correct. Now, on the credit side, I want us to begin with capital. And capital, as per the equation, is given as 842,500. So we have capital of an amount of 842,500. We're supposed to add the net profit that we realized. So we're supposed to add our net profit that was realized from this particular business, and the amount was 96,720. So the amount was 96,720. When you add these two, you're supposed to get a value of 220. Then of course we have our long-term liability. These are liabilities whose payment can take up to 1 year, more than 1 year, long-term liabilities. And other long-term liabilities, we are supposed to have the first one as bank loan. A bank loan of 250,000 is payable in installments more than 1 year, so we have bank loan. So bank loan is an amount of 250,000. Because we don't have any other long-term liability, I want us to talk about the current liabilities. And we get an amount of something to do with the creditors. Creditors are payable within 1 year, so we have creditors, which is an amount of 216,000. Another one could be, remember that when you're starting about our work, we talked about the accrued rent. Accrued rent, I said, is supposed to be added to rent, and again it will be added to the balance sheet as liability. So this is an increase in rent which is supposed to be paid within 1 year, so it's supposed to be forming part of the current liability. So we have accrued rent of an amount of 3,500, and when you add these two, we get a value of 219,500. So when you add the 3, when you add 939, 220 plus 250,000 plus 219,500, we get a value of 1,408,720. Then after that, we are supposed to go to the asset side. So normally we have two types of assets. We have fixed assets. These are assets which can last more than 1 year. So fixed assets, the first one is supposed to have, of course, you have the motor vehicle and the furniture. And I said we only carry to the balance sheet the book values. That is the values after depreciation. So for motor vehicle, we have 612,000. So we have for motor vehicle, we have an amount of 612,000. We are supposed to add to it the furniture, can also last more than 1 year. Again, the book value of furniture is 270, 720. So furniture, book value is 270, 720. When you add these two, you're supposed to get a value of 882, 720. 882,720,000. And then of course we go to current assets. These are assets which cannot last more than 1 year. In other words, they are assets which are liquid in nature. They can be easily converted to cash when payment of liabilities arises. And we are given stock on 31st. Stock is a good example of current assets. So we have stock of an amount of 72,000. Another one that we have is the debtors. These are customers who owe the business amount of money, 244,000. We are given bank money in the bank as 50,000. So we have bank as 50,000. And cash, finally we have cash as 156,000. So we have cash as 156,000. The other asset we have is the prepayment. Like we had electricity prepaid of 4,000. This is an amount that had been prepaid, that had been paid but has not yet been utilized. So it means it belongs to this business as an asset. And I said it is supposed to be transferred to the balance sheet as an asset. So you're supposed to have electricity electricity prepaid of an amount of 4,000. Prepayment is an asset, 4,000. So when you add these 72,000 plus 240, 244,000 plus 50,000 plus 156,000 plus 4,000, we get a value of 526,000. This is the total of the current assets. So 526,000. We add it to the fixed assets. So add it to the fixed assets of 882,720. We get a value of 1 million. So we have a value of 1,408,720. This is how we do our balance sheet. Now we can say that our assets are equal to the capital plus the liability, which essentially justify the bookkeeping equation. Thank you very much, and if you find this video helpful to you, kindly subscribe and share. Thank you.